MACD indicator. MACD stands for Moving Average Convergence Divergence. It was developed by Gerald Appel in the late 70s. It consists of a MACD line, which is generated by calculating the difference between 26-period exponential moving average and the 12-period exponential moving average. This creates a fairly fast but not too choppy line. The signal line is a slightly slower reacting 9-period EMA. And here's an important note. I get asked this all the time. I always use, on every time frame chart I use, I always use the default settings on the MACD. That way, I really only have to speak the one language, and it's the settings of the MACD, the default settings of the MACD. And the way I look at how it reacts in different situations is, rather than change the settings of the MACD, I change the time frame of the chart I'm working on. So I might move from daily to 360 minute to 240 minute, and look and see where I'm getting the information that I'm looking for on the MACD. The diff histogram is a graphic representation of the distance between the two moving average lines at any given time. The diff is a remarkably fast indicator of changes in momentum. So here are the elements or the components of a MACD indicator. The blue line on my charts is always the MACD line. It's the faster of the two lines. So you can see that when this really started to move up, it moved faster to the upside than the red line. It was slower. The red line is the signal line, or the EMA. And Gerald Appel just put that on there so that when you see a crossover, it can give you a signal. We'll talk about the different ways to look at the traditional MACD signals. That's coming right up next. And then the histogram bars are a representation of how far apart these two lines are. Notice that they're right together here in the histogram. There virtually is no histogram there because they're together. But then they split apart, and the blue line is up above the red line, and so we start getting taller green histogram bars that shows how fast this line is moving up. So if you look at these histogram bars moving up through here, that's during this phase of the price movement right there, which is very strong and has a lot of momentum behind it, and that's what those represent. But then the momentum starts to wane, and even during this portion up here, it's continuing to wane, even though these are going up. And the reason is that the reason the histogram bars are getting shorter here is because these lines are getting closer together as they finally get up here and come right together during this period here. And then there's a zero line. So the way my MACD works is if the blue line is above the red line, you get green histogram bars above the zero line. And if the MACD line, the faster of the two lines, is below the red line, you get red histogram bars below the zero line. So traditionally, traders use the MACD for if they're going to use it for trade signals, they use it in the following ways. One is an EMA crossover, especially after divergence, zero line crossover, the KISS, zero line bounce, and a recross above or below the zero line. So let's look at those different ones and see how good those signals are. Here's one that shows every time the MACD crosses. I've got, if it crosses and then the blue moves above the red line, I put a green signal line there. If the blue moves below the red line, I'm putting a red signal line there. And through this stretch, using weekly chart, there were 15 from mid-2007 to present. There were 15 MACD EMA crossovers. And of those, I put an X by the ones that would have been a lousy trade. For instance, you don't want to get short at the end of that candle. It immediately would reverse. That would have been a losing trade, so they put an X there. And so there's an X on the ones that weren't good trades, and then if it was a good trade, there's no X there. And you notice that 7 of the 15 was a lousy trade. So this is not very good. However, if you only take the signals of the MACD after divergence, then the signals were good. So here's an example right here where the price made a new high above this high here, but the MACD didn't make nearly as high a high as it was up here. That's called divergence. And so when you get those two cross after divergence, that's what that red line is, and that is a sell signal. And you didn't get a buy signal across after divergence until all the way down here, the second candle after the March 2009 low. Would have been able to catch 95% of this move using divergence, a MACD cross after divergence. And then getting along here, the flash crash would have given you a cross after a slight bit of divergence. And so that would have been a very nicely profitable trade. The only problem is it didn't get you back into this long because there was no divergence here to get us back in. So that signal is very good, but as you can see, they don't come around that often. Then there's the zero line cross. So that's only when that blue MACD line crosses across that zero line. So we got a sell signal here, it was good. We got a buy signal here, that was good. We got a sell signal here, it was terrible. It would have immediately gotten taken out of loss there. And then it went across back over the midpoint line, that was a good signal here. So 3 of the 4 signals were good. And one of those signals would have gotten you, would have helped you catch this latest upswing since July of 2010, the majority of it. Then there's the KISS. The KISS is where the MACD lines come together, but they don't cross, and then they split back apart. And you can see that that is was a very powerful signal here. It got you in just before the point of recognition of that wave 3. And the only other KISS I've seen on this thing is where the MACD lines crossed here, they came back together here, and then they split back apart. And that would have been an okay signal, but not great, because it's already been reversed and would be at a loss if the person was still holding on to that short. Which brings up a good point. On when I'm figuring whether these signals are good or bad, I assume that if you get nicely into profit, you're smart enough to move your stop to break, at least to break even. Traditional MACD signals. Here's a zero line bounce. It's a good signal, but as you can see, it only happened once in this entire time where the MACD came down and pretty much ran along the zero line and then bounced off of it and started moving back with the trend. And that would have been a really good signal right there. And frankly, that's a signal problem an Elliotician would have taken, because after, if the long-term count was correct, they would have seen an A and a B and a 1 and a 2 and a possible breakout above 1 right here. There's a lot of reasons that would have brought that, that would have been a good decision-making spot, but the best way that traditional MACD would catch it would be with the zero line bounce. Then there's the EMA recross above or below the zero line. That's where you were negative below the zero line and it crossed back, but then it turned back negative and it was below the line. That was a good signal here. And this is where it crossed to the upside, crossed back down, and yes, it did cross a little bit, and then a recross here. That was a good signal here. And this is where the crossed bearishly, crossed back positive, except the only problem is it's above the line there, so that I shouldn't have put that line there on this example. There are no examples. So there's 2 of them on this chart, and they're both pretty good. So if we take all of those different signals that the MACD, with traditional use of the MACD would give us, the EMA across after divergence gave us the best signal and earliest signal here, here, here. It didn't get us in here, but the zero line bounce did get us in here, along with a breakout trade. And if your ElliotWave account was correct, I think you would have known to get in long right there. So those are the best that MACD has to offer. However, I've also notated on this chart. In this particular instance, if our wave count was correct and we saw that we were getting divergence, potential divergence, and we got a Japanese candlestick indicator, in this case they're almost always the engulfing style. We've got a bearish engulfing candle right here, and you would have already seen divergence on, this is a weekly chart, on a daily chart for sure, and then that kind of bearish engulfing candle on a weekly chart could have gotten into this trade about 4 candles earlier than that. In this particular case right here, you could have gotten into the trade one candle earlier because of the bullish engulfing, and yet you would have seen that you would have known that if that bullish engulfing was nearly complete and was going to end up anywhere near where it looked like it was going to end at the end of that week, that it would cause divergence as soon as that closed. And so a person could have gotten in 1 candle earlier there. And believe it or not, based on a bearish engulfing candle right here, a person could have caught the entirety of the flash crash rather than waiting until it was open. And so, and then that zero line bounce. So those what happened here. However, there was a bullish engulfing candle 4 candles prior to that, right here. And I'm going to trust that everyone knows how Japanese candlesticks are constructed. If you want to brush up at all on Japanese candlesticks, I know there's on my site down here on the links and blogs, this one called School of Pipsology at babypips.com. It's entertaining, and it's basic. There's a lot of good information there. A fairly lighthearted approach to showing it all, so it's not too dry or boring. But my very favorite of the Japanese candlesticks is the engulfing candle, that's where it's, if you're in a downtrend like this, and then you get a candle that completely engulfs the previous candle, 2 or 3, it's so big and it ends almost as a one solid block like that. It's a bullish, or it's very near at the top of its range. It's a bullish engulfing candle. It's very powerful. Another indicator that you may be at the end of a trend is a hammer candle. And by the way, I always use Japanese candlesticks on daily or longer charts. I think you get a lot of more false signals out of them trying to use them on 4-hour charts or something like that. So daily, really weekly is the most powerful. But the daily, I think, is still good. But if you're into the downtrend, I call this a pin candle. I don't worry about whether it's called a hammer or a shooting star. But it basically is where the trend was continuing on just fine, and all of a sudden in the middle candle it reversed, and the tail ends up over twice as long as the body of the candle. And you can see that this was pretty much a pin candle. And then you get the bullish engulfing. There's two candles right there that are screaming trend change. There's the piercing candle where it gaps down, fills the gap quickly, and ends up being a bullish bar. It's the end of the downtrend. Of course, the opposite of that is called dark cloud cover. Gaps higher, fills the gap quickly, and keeps going and closes down in here, and closes probably past the halfway point of this candle. There's a lot of people that got long up here that were getting short, and then it's going to propel this thing on further to the downside. And then a doji candle, I'll point those out. That is a point of indecision that happens all the times in the markets. So I use these on daily, weekly, and monthly charts. And there's a whole bunch of books and places on the internet. I would just find it's just a quick summary of the most popular candlesticks. Just print it out and pin it on your wall so you can have quick reference to those. But it's amazingly enough, the Japanese candlesticks still, with the way I do things, and since I can only trust the dailies are greater, oftentimes I'll already know that we're at a trend change because the MACD will have given me a very accurate ElliotWave count for some reasons that I'll point out in a second. And I will have already seen, before a daily Japanese candlestick pattern completes, I probably will have already seen divergence on 120 to 180 minute chart, MACD divergence, showing a completion of some sort of trend. So let's see how that works. So the moral of the story so far, The MACD on time frames longer than 240 minutes is best utilized as a way to ensure accurate Elliott wave counts, not necessarily as a signal generator. We've already determined that even Japanese candlesticks give a quicker signal than the MACD on a daily or on longer term frames. So if your wave count is accurate, and I'll show you how to use the MACD to give you much more confidence in wave count, you'll already have Fibonacci and trendline targets in place, and we'll be ready for the trend change before any of the traditional MACD signals occur. And we'll be looking for divergence and or a histogram turn on shorter term charts, 45-minute to 180-minute charts. So that's likely going to give you the earliest high confidence idea that you've got a price turn coming that's going to be of substantial enough nature to try to grab a few pips on. Therefore, in a daily and weekly chart, the best of the traditional MAC signals are most effectively used as confirmation. And for that matter, even ElliotWave, with a correct ElliotWave count at your side, even Japanese candlesticks on a daily basis can still be considered a confirmation of what you're already going to know, but even slightly earlier than the most traditional MACD signals on 240-minute or greater charts. So how I use the MACD to develop more accurate wave counts. So we've got a half an hour from here to really dig in to this part of the webinar. And objective number one, have an accurate Elliott wave count. So how do you do that? Well, the MACD helps a ton. I'm getting a question, how can I get confirmation of my recording of Elliott wave? When do I know that it's correct? I'll show you. That's we're getting right to that, John. So I use the MACD line to pinpoint the strongest points of momentum, which are generally at wave 3 extremes. This is huge. Use the MACD to help figure out where your wave 3 extremes are. And then I use the histogram extremes to pinpoint smaller degree wave 3s inside of the extended wave 3s. See if I have an example of that. Yeah. Here's the U.S. dollar index going back to 2008, March of 2008. 1, 2, 3, 4, 5 is my count. Look at the MACD. It's at its very highest point on weekly chart at the wave 3. Then you get a wave 4, and then you get a new extreme for wave 5. Very aggressive, almost a straight up move, and yet MACD cannot make a new high. That is called divergence. But it also gives you a high degree of confidence when you see that new high that this was a 3 and this was a 5, and your 5-wave impulse is done, and chances are very good you're going to see a substantial correction, especially when we're looking at a weekly chart, and these are huge moves. And then you can see that I'm counting this down move as a 1, 2, 3, 4, and then an extended 5. 1, 2, 3, 4, 5. And these pink lines are the histogram bars. That's these red bars are at the very deepest point right here, and that's pointing out the wave 3. And then the very deepest point of the MACD line itself is pointing out the wave 3 of 5. And then this last little bit right here, the MACD actually moved up. And if we could zoom in a little better there, we'd see that we had divergence there and a cross right here, including bullish engulfing candle and some other things. So, and a break of a trend line connecting 2 and 4. So you would have known that 5-wave move was done. Well, after a 5-wave move, and you get a 5-wave move like that, and this came out of nowhere. This ABC goes all the way back to 1985, and all of a sudden in a 1-year period, we get a strong 5-wave impulse. But then we get 5 down, so we're expecting 3 up and 5 more down. the 3 up, not to a new extreme, so that would be a wave B of a zigzag. So 5, 3, 5 zigzag, but not below the start of the whole structure. So so 5, 3, 5 zigzag, and that zigzag is going to either complete a wave 2 or a wave B in burgundy here. So we have a 1 or A, B, C, 2 or B. And then over here, it's interesting to note that the deepest part of the histogram, to get back on the point here, is pointing out the wave 3 of this wave C of this ABC zigzag. It's pointing out the wave 3, the deepest part of the histogram. And then the deepest part of the MACD line itself, of this whole structure here, is where I've placed the wave 3 label. This is, so being completely aware of the extremes in the MACD line and the extremes in the histogram really helps me determine where to put the wave 3s and the wave 5s, and then build the rest accordingly. Also, the histogram, if you're in a wave 5 of 5 of 5, the histogram is going to be one of your very earliest indicators of the trend change. So, let's say you got divergence here, and your histogram's all red, and then all of a sudden you get this little green one here, and and you look up here, and lo and behold, it's a bullish engulfing candle. Very early, the histogram will many times give you a signal right there as early as the Japanese candlestick of trend change. I also look for divergence between the MACD line and actual price. Divergence is when the two are moving in opposite directions. This most often points out wave 5s, as they quite often make a new price extreme, while the MACD does not, which, depending on the larger Elliott wave count, warns of an imminent trend change. We already talked about MACD divergence being an excellent signal, and it's one of the best ways to use the traditional MACD signals. Some more key tips on utilizing the MACD. If the MACD is giving too much or ambiguous information on one time frame chart, for instance on a 60-minute chart, switch to another time frame, for instance a 2-hour or a 45-minute chart. So here's the Dow Jones 180-minute chart. Well, you can see that I'm wanting to count this as a wave 3 and this is a wave 4. I felt like those were already set in stone. And notice that we did get a divergence at the end of this correction right here. The lowest point of the MACD is back here, but the lowest point of price is there. Divergence. Actually, lowest point of price, you got 2 sets of divergence there. Okay. So the lowest part of the MACD is here, and even though it kept pounding its way down to new lows, the MACD did not. So when then we got this little green histogram bounce right here, a bullish engulfing candle, boom. This would be a zero, called a zero line bounce right here. As soon as you get a green histogram right here, boom. I mean, if a person had taken that, they never would have seen hardly any loss whatsoever on the trade. I never would have moved into loss even just for a second. This would have just kept going up. And this move up is so aggressive. That's why I want to call this a 1, 2, 3. Remember, we can use our trend line thing as well. That's where, let's say I'm not exactly sure. We'll make this purple. So we don't know if this is going to be A, B, C, or pot, so we draw a trend line there. Place it at the extreme of either the 1 or A, and you can see it just cut through it like a knife through butter. Another great signal that we're in a wave 3 here. The MACD is also pointing out the wave 3, and then the waves 4s often come down to the middle point of the line right here. And then this move is up. And look, the MACD is flattening. This 1, 2, 3, 4, 5 could be over or very, very close to being complete. This is if this turns negative, and it hasn't yet, it's flat. And this is on a 180-minute chart, which is one of my key time frame charts. I like signals on 180-minute and 240-minute charts a lot. That'll give us divergence, which means this move up to here is probably about done. We're going to see some kind of relatively solid move to the downside, some sort of correction. But I'm highly confident because of the MACD that is a 3. And look at the histogram. Histogram, the very highest point of the histogram is right there. That's right, the 3 of 3. That happens a lot. Histogram shows you the 3 of 3. The histogram, it's the bar line itself. I'm sorry, the MACD line itself will show you the actual apex of the wave 3. This gives us confidence in our wave counts, and we're getting the divergence that we would typically look for in a wave 5 here. So it's the beginning of the week here is going to be very important to keep an eye on what's happening on the MACD on 180, 240-minute charts on the stock market. And then also, you know, if you're looking at this is a 180-minute chart, and I'm going to place those same vertical lines and again at the very extremes, and I'm going to make them bigger. Can you guys see that pink line pretty well? Hope you can. So that is showing, yes, good, thank you. It's showing the wave, the top of the histogram and the top of the MACD on a 180-minute chart. And you can see this line is just one candle late there, and this is probably 2 candles early. So we're probably dialed in pretty good. If we look at the same thing on a 240-minute, now see on a 240-minute, it is nailing the top candle. And that histogram, top of the histogram actually was right. 1 candle further there and is nailing the wave 3. So this is how I tune in my chart to the speed that the market is going. I have a high degree of confidence that on a 240-minute chart, the histogram bars and the MACD line, at least during this structure right here, are pointing out the wave 3s beautifully. And also notice, now that I've got it tuned, it's kind of what I call tuned in, the MACD line isn't through going up yet here. It hasn't rolled over and flattened yet. It ended at its very highest point. It's still sloping to the upside, and that's why I think we're probably going to get a little upside push to start the week before we get a little bit of a correction. But I don't think this particular divergence, you notice I've written here, the MACD line slope is about to turn negative for 180 to 360-minute divergence, which is usually a strong signal, but I don't think it will amount to much this time because we're expecting a wave 2. Now, wave 2s can be deep. It is possible that they're deep, but because of this move was so strong right here, there's still, and this move here, there's a lot of upward push to this. And if you look at the S&P on a daily or on a weekly chart, we've had 2 bullish engulfing candles within the last 4 candles. That's a lot of upward momentum. So that's part of how I look at a picture, and even though I'm seeing divergence on a 240-minute time frame, I'm not sure that's going to be a very good short. Not yet. The wave count doesn't, I don't think, is complete yet. And there's another reason that I'll just quickly show you guys, in case you just came into this webinar and did not are going to be in the counts webinar, is this upward move in the S&P. We've got a 1, 2, 3, but 4 came down and overlapped 1. Remember, that's not allowable in ElliotWave, except in the ending diagonal. And these waves can be counted as zigzags, all of them. So I'm thinking in the S&P, because the overlaps were, there was no overlap in anything else. This is probably 1, 2, 3, 4 expanding ending diagonal. And I'm expecting an A, B, C to end this move and this, frankly, this bull market fairly quickly here. So that's one of the reasons in my Dow Jones video that I did last night and posted that you may have seen, that I'm expecting maybe just a little bit of up movement Monday and Tuesday of this week to complete this A. I'm thinking that the stock market will probably end the week lower than it starts this week, and that'll be this wave B. I'm expecting S&P, and then the final charge on up. So remember that in the diagonal, each 1, 2, 3, 4, and 5 are all generally ABC structures. Also, this gives us a down up that we would expect in the S&P, whereas basically that's kind of what I'm expecting in the Dow. Once this blue 1 finishes, then we get our wave 2, and then up to the top. So it allows them to move in similarly, even though the count is slightly different on each one. So that's the MACD will reveal different information on different time frame charts. So if someone says, I'm seeing divergence, you must ask them on which indicator, MACD, stochastics, and using what settings, the default setting. With me, it's always going to be the MACD using default settings. When I say I see divergence, you can assume I'm talking about MACD divergence using this default setting. But the other piece, very important piece of the puzzle you must know is on what time frame chart. Because you can see how I just showed you that I'm not on a 240-minute chart. This up move isn't done yet. This might have been just a slacking off at the end of Friday after everyone had got home, and it could continue up for a little while. I expect that it probably will just a little bit. But on a 120-minute chart, we go all the way to 120, we can see that we already are showing divergence on a 120-minute chart, where this was a high, this came down for wave 5, and then theoretically that would be the end of this move up here. So the 180-minute chart, though, isn't giving us our very best reads on where the 3 of 3 is and the actual wave 3. That read, when we synchronize our time frame to the gear that the market is running in, we found that the 240-minute chart gave us the rock solid right on the right candle wave 3 top and histogram wave 3 of 3. So this I'm finding, it says 180-minute, and that's not correct. This is on a 240-minute chart. That, I think, is the correct time frame to count on when this divergence is going to be actually in. And according to this, it isn't done yet. I'm kind of getting ahead of myself, but that's what this next paragraph is about. The market shifts gears with speeds at virtually every swing high or low. So you should regularly be switching between the time frames to see what the MACD and the histogram are revealing on each. So as I switched from the 120, 180, 240-minute, 360-minute time frames, which are my bread and butter time frames to use in the MACD, I found that the 240-minute was giving me the highest quality bit of information during this up move right here. So I've synchronized my time frames with my chart, and this is going to be the one I'm going to trust for divergence. Any questions about that? That's a real key to what I do and how I use the MACD and how I synchronize my time frame that I'm counting on. And I use the wave 3s to synchronize the MACD so that I can see which time frame is going to be to give me the highest quality divergence reading coming up. Everyone's followed that really or have any questions about that? If you do, type them in the chat window, or just break in on the microphone at any point. You know that nearing the end of the presentation, I want to make sure I get through everything. So, more tips on utilizing the MACD. You should synchronize your MACD to the gear that the market is running in by switching the time frames. I just showed you how to do that. It's common to see divergence on a 120-minute chart, for instance, but not on 180-minute charts. I just showed you that exact thing. Divergence on longer time frame charts should be given extra weight, but don't expect to see divergence on time frames as long as weekly charts. It's longer than weekly charts, like monthly. Very rarely occurs. You could wait years before you'd see divergence on a monthly chart. It does occur. I've seen a little bit of it on the Dow Jones transports, but not on the industrial average. Divergence on time frames under 30 to 45 minutes is suspect due to market noise. As a general rule, I don't like to go down below 45 minutes on my charts, because at that point the MACD has a tendency to just follow price. Like here's a 60-minute chart of that most recent activity, and you can see that all the MACD, even though you did get divergence nicely on this high right there, pretty good divergence. Sometimes you can find multiple time frames that are showing you the good information, and I'd have to say that the 60-minute is giving about the same information here as I was getting on the 240-minute. But as I move into like a 30-minute chart, you know, this isn't doing anyone any good. This little move right down here. And it just isn't, you know, giving very good quality information. It just follows price. You know, you could just look for price. You get rid of the MACD and just follow price. If what you're really looking for is something that's a more serious, longer-term variety, in my opinion, MACD, to give you a high probability that you're going to see a sizable move. 90. There are many times when the wave count is just too ambiguous to rely on. It's during these times that utilizing MACD divergence on 120 to 180-minute chart or greater time frames to signal changes is a great backup plan. So I'm going to show you an example of that very quickly in just a second, a very recent example of it. So this is showing how the MACD, I already showed you how the MACD is pointing out the wave threes. The MACD, not only the MACD line, but the histograms itself. And that was on weekly candles. Then when we zoom in and look at daily candles, it's giving the MACD line. Notice back here on this high right here was nailing the black wave 3 on the weekly. When you look, when you're operating on the daily, the height of the histogram is clearly at the wave 3 of 3, the blue 3 before the black 3. And you got divergence at the end of the black 3 showing on a daily chart. And then you got additional divergence right here where wave 5 made a new high. So you got two sets of divergence. One is here to here, and one is from here to here. So it gives you different information on each time frame. Zooming on into the same data, here's a 240-minute chart. And we can see that the MACD is pointing out this orange wave 3, this 1, 2, 3, 4, 5 right here. Divergence. Very nice, powerful signal. Then it climbed up right here, and we had a histogram extreme here, and then a MACD extreme here, putting out a 3, those 3s that I've got marked there. Divergence, end of a 5-wave impulse. Then this is an example of an ABC for B, C, potential expanded flat, although amazingly enough, as it turned out, that isn't exactly what I think this was. It's just as likely that this was A, and then we had A, B, C, D, E of a triangle. So even though didn't know for sure what the count was here, the histogram is going to give some. I'm not the histogram. The MACD is going to give some good signals anyway. Like here's the histogram extreme. The very deepest part of the histogram anywhere along here is this orange 3 here. 1, 2, 3, 4, and then 1, 2, 3, 4, 5. Extended 5. Deepest part of the histogram here, pointing out the 3 again. So the histogram line here and the histogram points out this 3. The MACD line here points out this wave 3. We get divergence, very powerful signal, and you can see what it amounted to there. And so the market gears. Here's a chart I developed where the market runs in different gears. At every swing, it changes gears. It's like a Le Mans racer that's going through city streets that have been blocked off, and some of these turns are hairpin pin turns with a short straightaway ahead of them, and others are more gradual turns with a longer straightaway ahead, and so you'd be running in different gears of your race car depending on the needs of the particular situation. And even though this is a 240-minute chart, you can see that, and what I did is I denoted down here the longest time frame chart. As I changed the time frames here and looked at this same data in different time frames, I'm showing the longest time frame chart that showed me divergence at the end of the move that was tradable divergence. And you can see right here, this is a 240-minute chart, and I can see it clearly. There it is, and there it is. But that is only the only real clear-cut divergence you can see on this chart, although you can see it a little bit here. It really shows up better, much more defined on a 180-minute chart on that top. Whereas this top here, you have to be on a 120-minute chart to find divergence between this top and this top. And down here, between this last little move down, you'd have to be on a 90-minute chart to see that, so on and so forth. And that's not knowing that this is going to be a triangle or a WXY correction, when we look at a particular post that I sent out, it would have been back on this day around June, first week of June. This divergence was definitely looking like it was going to complete right here on a 240-minute chart. Well, a 240-minute chart is going to give a deeper signal a deeper move than like a 120-minute, which only gave that, or a 90-minute, which just gave that. So the largest tradable move that I saw or see on this chart was signified by a 240-minute divergence. And when I was looking at that particular data as it was occurring, I was zooming in. I was seeing a divergence for sure on a 180-minute. I was seeing it develop on a 240-minute. And then I zoom on in, and here's a 45-minute chart of that same top. And here's that wave 3, 4, 5. And what that is referred to as this 3, 4, 5 right here. And so when we move into the 45-minute chart, we still are getting a very, very solid divergence here. And when these lines crossed and you got the first little red histogram, that's where I drew this red line, which would have signified getting short. Well, I've already seen a divergence on a 180-minute chart, seeing the possibility of it on the 240-minute chart, and on the 45-minute chart, got the earliest possible histogram confirmation of a trend change up here, would have been able to get short there at 1.6916. And then looking for a shorter term divergence to get out of the trade, the next divergence I saw on a 60-minute chart or greater was right here. There's a 45-minute divergence. So once this kept going lower, but MACD couldn't, and saw a green histogram bar right there, and we've got a bullish engulfing candle, that would have been the first divergence signal of 45 minutes or greater that was available anywhere along here, and that would have produced a 275 pip profit in a matter of day and a half, something like that. So there's an example right there of MACD divergence on a 240-minute chart, giving a very nice trade and not getting in until you see a divergence on 180 to 240-minute, but being very aware of divergence on maybe a shorter term, like a 60-minute, because when the market does make a turn, it will change gears. So it's, as a matter of safety, once well into profit, I look at a shorter term chart and look for divergence there as a signal to get out. So putting it all together, with the assistance of the MACD indicator, and it's pointing out your wave 3s, and the MACD histogram pointing out the wave 3 of 3s, and looking for divergence at wave 5s, and using all different multiple time frame charts as you constantly are trying to synchronize your chart time frame to the speed that the market is running in, you can develop accurate, high confidence ElliotWave counts. And as long as you have that accurate count, you're in a very strong position to look for trend changes at specific Fibonacci or equality targets, wave 4 retracement targets, etc. Be flexible as to the time frame you're examining. Never make a decision based on a single chart. My biggest mistakes I ever made trading was I thought I saw something on a chart and I jumped in and I didn't triangulate around it and look and see, you know, maybe I was trading on a 5-minute chart or a 15-minute chart, and I didn't realize that there was already divergence on a 240-minute chart, and I was completely getting in the trade the wrong direction based on a chart that was such a small time frame that it wasn't able to see the bigger picture of where things were going to go. So use multiple charts, and you see that what I do, I've got a quarterly, monthly, weekly, daily, and then the way I label that one is a daily M, main count. And then I have a daily A, alternate. And as a matter of fact, I have 2 alternates. So I have daily alternate 1, daily alternate 2. So that's, and then I also keep a shorter term chart that is currently set for 180 minutes. But that's the one I'm constantly switching time frames with, all the way from 45 minute to 360 minute, and synchronizing it with the market. So I really keep, you know, 7, 8 charts of the same thing up all the time, and use, and that way I don't have to switch time frames as much on a single chart. So if I change this to a weekly chart, you can see that all the junk gets glommed up. I can't see the candles anymore. So this is my intraday chart that I use, and sometimes if I'm actively trading, I might use one chart for 120 through 360 minute. I use another chart down in the 3 to 45 minute range to really get into some detail, so I know exactly where I'm at before I take a position. Be ready for turns ahead of time as the wave count nears maturity, and gradually work into lower time frames as longer term divergence develops. Just the example I just showed, I was seeing divergence for sure on 180 minute, and with good likelihood that it was going to roll over and show divergence very, very soon on a 240 minute, and then jump down under this into a 45 minute chart, and saw that I was seeing divergence even though on a smaller scale there as well. So it seemed like a great opportunity. That one it's an excellent way to use the multiple time frames to your benefit. Also, be just very aware of the different multiple time frames as you near Fibonacci and trend line targets. As the projected trend change point nears, a change in the trend of the MACD histogram bar height can be one of the earliest indicators available. We also use Elliot trend lines, daily and longer Japanese candlesticks, and traditional MACD signals on time frames greater than 240 minutes as confirmation that you were correct. There's nothing better than getting in based on triangulating your way around and maybe finally getting in on a lower time frame chart, and then you gradually see the confirmations occur on the longer and longer charts all the way to the daily and maybe even the weekly.